Hello, everyone. Today on the final bar, we'll talk about this choppy market environment. The word choppy, I feel like I've used many times in 2022, but especially in the last week. 2 weeks ago, we had the acceleration to the upside on Friday, particularly pushing onward. Last week, shortened holiday week, 4 trading sessions, a lot of chop. Really didn't make up any ground. Today, more of the same, more of a digestion phase. What does this mean for the major averages? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the data visualization techniques on StockCharts.com to make sense of these markets, to try to understand what's happening from a technical perspective, fill in all the blanks by focusing on the activity of the markets as defined by price. First book I read on technical analysis was John Murphy's Technical Analysis of the Financial Markets. Before that, it was called Technical Analysis of the Futures Markets. He really talks about just the general justification for technical analysis. And that's basically that price reflects what investors are thinking. I'm summarizing John's words, but that's how I've always approached it. If you want to get inside the head of other investors and think about what they're thinking about, understand what their motivations are, and most important, understand their emotional state, because the markets are driven by fear and greed. Price is the best way to do it. We're going to focus on price in 3 components here on a Monday: big picture macro analysis, sector rotation, and then individual stocks as well. So a lot of great commentary coming your way here in the next 30 minutes. First off, I just want to let you know some of the great guests we have. We had a couple of really good conversations last week with some of our guest commentators. Dave Landry had some really interesting ideas. Jay Pettit from Charts Avenue joined us from Singapore. This week, we have 3 really good guests as well. On Tuesday, the 7th, we have Larry Tentarelli from Blue Chip Daily. On Wednesday, the 8th, Sam Stovall from CFRA Research. On Thursday, June 9th, we have Pat Saresna from Big Picture Trading. All repeat guests on the show. All have done such a great job of sharing their perspective. Excited to hear what they have to say about what I would still label as a bear market rally. We'll see what our guests think later this week. We need to continue on today's show with our market recap. Let's start big picture, talk about the overall market environment, looking at equities, but also some of the other asset classes as well, because some interesting movements we want to be familiar with. The S&P going up about 1/3% today, but it was up much more earlier in the day. Look at this. I'm struck by how this feels like an attempt to keep going higher that just keeps getting repelled, right? Buyers are coming in, but there's plenty of selling that meets that influx of demand. And overall, the S&P just finishing a little bit above the lows of the day, finishing up 0.3%. The NASDAQ composite up 0.4%. Mids and smalls up as well, with small caps leading the way higher, up 2/3%. The VIX higher as well, but certainly not elevated relative to recent history, pretty elevated relative to long-term history. So 25 is higher than the average number for the VIX, but below 30, 35, which is what we've been more experiencing in recent months. Looking at interest rates, the 10-year yield regaining that 3% level. 10-year yields had gone below 3%, while the longer end of the yield curve had remained above 3%. 10-year was coming off a little bit into the 290s, if not a little bit lower, back above 3% today after Friday closing just below it. So overall, you have rates continuing to go higher. We have bond prices as a result going lower, the dollar moving stronger. So we're back to that old, consistent sort of familiar theme of higher rates, stronger dollar, and what that, what potential influence that tends to have on certainly leadership themes in the equity space. Gold and silver disagreeing a little bit, with gold down on the day, silver up on the day. That's using the 2 ETFs, GLD and SLV. Oil prices off a little bit, broader commodities up a bit, and the energy sector is actually flat today. Energy, by far the strongest sector year to date in 2022. Not really feeling it today. Most of the top 10 coins that we track in the crypto world are in the positive today, with Bitcoin up 5%, Ether up 3% from yesterday. Bitcoin powering above 30,000, actually finished the day yesterday right around 30,000 and then just accelerated to the upside earlier today. Again, currently up about 5%, 31,400, we'll call it. Let's look at the equity markets using the S&P 500. And again, we are met with another day that is just perfectly within this range. If you look at what the market has actually done over the last couple of weeks, the bottom in third week in May is here. We have the rally off of the lows, 4 days out of 5, really accelerating to the upside, culminating in 2 Fridays ago, not last Friday, the Friday before, powering above 4150, powering above that first 38.2%, or that first Fibonacci level, 38.2%. At that point, all of a sudden the market looks pretty positive, a lot of strong demand getting to a new swing high. From there, though, that's been it. And if you look, the next 5 trading sessions, the shortened holiday week last week, and then today's session, all essentially right within that range. So after that Friday's rally, we've gone nowhere. Basically, investors overall are netting out in agreement that the S&P is worth about 4,125 points. And we just keep over and undershooting that level. That is what the market is telling you. There's no real clear catalyst. We're in wait and see mode. John Bollinger has said that one of, I think, his great contributions to technical analysis is Bollinger Band's obviously very popular, but if you think about what it's actually doing, it's talking about volatility, talking about expansions and contractions and volatility. When you have a big move and then you have a contraction in volatility, meaning a big thrust to the upside, and then we sort of come in and the volatility is coming, narrowing, that basically is setting the stage. That's priming the pump for the next big move. And his, suggestion in this sort of environment is wait to see which way the break is. Do we break out of this range to the upside? Do we break out of this range to the downside? Whichever way we go, that is most likely the influx of momentum. That is the momentum one side has taken control, and you are best served by following the direction of that break. So I think at this point, we remain in wait and see mode, and I think that's what the S&P chart is certainly suggesting here. Overall, though, if I had to label it, I would probably most likely still label this as a bear market rally until proven others, right? Until we get more of an improvement than what we've seen so far. I just want to finish off our big picture discussion here, our market recap, looking at some broad market indicators. I do want to look at the chart of the TLT. So we often look at the $ TNX, which is the 10-year interest rate. We've seen that uptrend pull back to the 50-day moving average, now rotating back up to the upside, nearing another new high for the year. If we flip that chart over, it's essentially the chart of the TLT, which is a long bond ETF. We look at the TLT and ag, a number of different things. What strikes me about this chart is how this looks like a bear flag pattern. What a bear flag pattern is, you have a big move down. You then have a corrective wave, meaning a wave in the opposite direction of the overall trend. And it's a little parallel short-term channel of higher lows and higher highs. When that channel breaks to the downside, which it did here in early March, that suggests much further downside. You see a number of these sort of bear flag patterns. And we may have just exited yet another one of those in the month of May, sort of finishing off in June. The big acceleration to the new low in early May. From there, higher lows, higher highs. We've now broken that channel to the downside. What that indicates, what that suggests, is bond prices going down, interest rates pushing higher. And again, what that leads me to think is what that would mean for growth sectors, right? That environment with bond prices going down, with interest rates going higher, just doesn't tend to be great for growth stocks, because a higher rate environment makes their explosive growth, the potential in earnings, less attractive relative to other things you could put your where you could put your capital. Lower rates would usually be more helpful for growth stocks and more difficult for value stocks. So essentially, this continued downtrend in bonds suggests value over growth. That's certainly been the theme year to date in 2022, and it appears to still be the case here going forward. So I want to finish off looking at gold prices very quickly. So if we look, gold is right around the 200-day moving average, just using the GLD. Had another bear flag pattern, a big down move, sort of a parallel reversal, and then breaking that to the downside. We've sort of completed the measurement of that pattern, and now we're once again in a holding pattern, sort of this consolidation. You see how equities are consolidating, gold is consolidating, bonds even bounced a little bit. Sort of feels like it's setting the stage for the next big move. I wouldn't be surprised if it's a move lower in stocks, a move higher in interest rates. But we'll let the charts tell us what's actually happening before we get before we assume too much. Let's continue on to our next segment, sector setups. Talk about the big picture, the S&P in wait and see mode, gold stalling out, bond prices starting to revert back to the downside, higher rates potentially in store. What are the 11 S&P sectors telling us about the current conditions? We like to start with the RRG, the relative rotation graph. If you're not familiar with this, Julius de Kempener, as part of the StockCharts family, does a great job in his show Sector Spotlight, using this visualization, really educating on how it can add value in terms of understanding things. And I would point out, if you're not super familiar with this, bring up the RRG, and you can find it in our charts and tools category. Click on where it says groups, and you'll see a bunch of pre-canned groups that you can show on the RRG, looking at the 11 S&P sectors, which is what we're going to do here. But you can also look at asset classes. We can look at style and thematic indexes. We can look at asset allocation, look at stocks versus bonds versus commodities versus cash, and so forth. So a really good way of just understanding how assets are rotating around one another. Here we have the S&P 500 industry groups or economic sectors, to be clear, rotating around the S&P, which is the crosshairs right at the cross of the 100 levels. Further to the right means this is outperforming. This is using weekly data. So you can see that the energy sector, by far, the strongest performer year to date. We've been talking about that for many, many moons. We've shared the evidence on the charts that there's a strong trend that appears to be persisting. And we continue to see, we'll highlight probably after the great charts like MPC making a new 52-week high again today. That's the sort of continued uptrend you've seen in a lot of these energy names. No real indication that oil prices are done with their uptrend. The commodities are done with their overall bullish phase, and energy as a sector certainly differentiating itself in its strong absolute and relative performance. After that gets a little bit weird because you have utilities and healthcare, both of which have had fairly strong relative profiles in the last couple months, really started to emerge, but both of them heading due south. And what that means is they're still outperforming, just the momentum's coming off a little bit, right? Not as strong as they had been a couple of weeks ago, but overall still outperforming, still doing just fine. It's more of a cyclical, pause in that stretch of outperformance. After that, it's consumer staples and materials, rounding out sort of these 5 strongest sectors in the S&P. What are the weakest sectors using the RRG methodology? It would be obviously these 3 in the lagging quadrant. Consumer discretionary, by far the worst of the 11, followed by technology, financials. Communication services is sort of an interesting one because it's sort of rotating, sort of a clockwise motion to the left of the y-axis, which is not a great look. That is, if you get the opposite, if you get that sort of move to the right of the y-axis, it's actually really constructive. That's what actually energy did a while ago. I remember seeing technology do that in years past. We're just keep sort of rotating up here. And what that means is the outperformance overall is continuing. It's just the pace of the outperformance that's fluctuating just a little bit. So overall, to summarize, it's defensive sectors and value-oriented sectors in the strongest side of this visualization. The growth sectors, the FANG sectors, really to the left of the y-axis, still suggesting value over growth as a general approach that has worked, and at this point, no sign that that is necessarily changing. Here we're looking at the 11 S&P sectors using our candle glance function. Last week, at some point, maybe the week before, we did a little snippet on the candle glance function. And it's I use this many times a day. It's a great way to take a list of ETFs, a list of individual stocks, your portfolio, a watch list, and just kind of lay them out on the table, right? What looks similar, what looks different, what catches your eye, and then click on the chart to drill into a little further. This is one of my favorite ways to use stock charts because you can start big picture, sort of look at all these different things, then do what I would call sort of a visual screen, see what sort of hops out, jumps off the page at you, and drill into that a little bit further. So what looks unusually strong relative to the other charts? Energy, the obvious winner there, and it's not close, right? If you look, how many of the sectors are above 2 upward sloping moving averages? Just a couple, and it's energy most obviously. After that, it's utilities and materials. Those are the only 3 sectors out of 11 that are above 2 upward sloping moving averages. So as you think about where you may want to be allocated, what sectors are showing the strength, what sectors are showing resilience, those are clearly the ones that do it. And it's not just on an absolute basis that you want to look at. The other thing that I like to do is change the time frame a little bit. So here we'll look at a 6-month chart. I'm going to add price relative, which is going to add relative to the S&P 500. Now I can look at these 11 sectors and focus on the last 6 months and which ones are showing strong relative strength. Now, forget this one because this is just the S&P relative to itself, so that's not really giving you much. It's sort of artificially in an uptrend. Out of the rest of these, which ones are showing a strong relative trend where the relative strength is consistently going higher? Well, here's energy. Look at how that relative line is doing very well. Here's materials. Look at how that is consistently outperforming. Here's utilities, right? And so you see energy, materials, utilities, those who were the strongest on the RRG, they're certainly showing strength on a relative basis. Healthcare would probably be the fourth one I would look at. Now, it's pulled back quite a bit. The problem with healthcare and with consumer staples that had been performing very well up until the first couple of weeks in May, from there, they're coming off a little bit. So if you do the simple exercise of rebalancing your efforts and focusing on which sectors are outperforming, make sure you back away from things like communication services or consumer discretionary, which are underperforming, and continue to do that at a regular pace. Overall, you're going to do just fine outperforming a passive benchmark. The S&P 500 will fluctuate its weightings based on performance, because that's going to change the weightings in the index. But overall, there's a lot that can be done with rotation just by focusing on the relative strength lines. And again, three sectors that seem to be the outliers: energy, materials, and utilities. We're going to take a break here in a minute. When we come back, we're going to focus on some of the individual stocks that are on the move, some of the more topical things like Amazon, looking at Generac and other things that have had nice bounces, but also some of the energy stocks that just continue to surface on my screen for new highs, including MPC. We'll take a quick break. We'll be back with shifting stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close. All of our previous episodes are on our on-demand platform. But first, I want to let you know that we are here for your questions. We'll do a mailbag segment on tomorrow's show. We'll do another one at the end of the week on Friday. One of my favorite parts of the show is hearing from viewers like you, what you're running into as you are trying to analyze the markets using technical analysis, using stock charts. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air in our next mailbag segment on Tuesday's show. Also, go to stockchartstv.com. Larry Williams did a great job end of last week with an update on his market perspective. We've had so much great commentary recently from our suite of hosts and expert contributors, also specials like The Pitch, so much more, all for free at stockchartstv.com. Or on your mobile device, just search for Stock Charts TV on demand. Let's move on to our next segment, shifting stocks. This completes our three-pronged approach that we do every Monday, starting big picture, talking about the macro environment, looking at some sector movements, and then focusing on some individual stocks and names. Just so you know, in the natural course of what I do, I end up looking at a lot of charts. I learned a long time ago. The life of a technical analyst is looking at thousands of charts every day. And I don't expect that you would spend as much time as someone like me does looking at charts, although you might. Some people certainly use the platform more consistently than I probably do. But I look at a lot of charts. So where do I find names that we're going to talk about in the shifting stocks segment? A couple different places, and I would encourage you to add these as widgets on your dashboard. First is our Scooter reports, which is here on the left, and I'm looking at just the biggest gainers, the biggest losers in the Scooter rankings, the top ranked names. That often helps you understand sort of the overall picture and see names like VLO that are just in these nice consistent uptrends that you want to be aware of. I like to look at the S&P 500 and see which stocks are up and down the most. Sort of thematic movements in the indexes. Breadth indicators can be, sort of illuminated by looking at the stocks that are on the move. The S&P 500 is a pretty decent universe to start with. The scanning engine is the other way that I tend to find things. And other than that, it's just things I'm hearing, things I'm seeing and reading. And I just want to look at individual charts to try to understand a little more about what the environment is at. By the way, if you look at the ACP platform, if that's kind of your thing, we have both of those as widgets in ACP. So on the right side, you'll see your chart lists. You'll see here the scanning engine. We can see, let's see here, market movers. These are the stocks that are gaining and losing the most during the day. Our scooter ranking. So all of those things that I have on my dashboard, I also have on ACP. You can look at them on either places. So make sure you take advantage of those. It's a great way to surface individual name ideas that you might not be looking at otherwise. We'll start with energy. I feel like much of the time I'm focusing on the energy sector and a broken record of sorts, but a broken record that continues to work is a broken record I'm very happy to continue to participate in and extend. And the reality when you're looking at MPC, when you're looking at VLO, any of these names, they just continue to go up and to the right. And again, I've been asked all during this uptrend, did I miss energy? How can you still say energy is looking attractive when it's up so much? And my answer is just showing you charts like this. For the last, it's made a new high every month. And it's the same like the S&P in 2021, where it just kept making new highs, right? As long as that keeps happening, you want to be there, right? You want to stop participating in something. You want to stop following a trend when the trend is no longer in place. Something like this, like these energy stocks that keep going higher, I want to ride that as long as possible. So the game here, I would argue, is hopefully you own it a lot before today. And if you do, it's to keep bumping up your stop, right? That's sort of the traditional money management technique. Every time it makes a new high or low, you bump up your stop a little bit, whether it's based on an average true range or just simply taking the most recent swing low, but just keep bumping your stop higher. Make sure you lock in paper gains as it goes up. And then when it finally reverses, you've locked in that uptrend. So I continue to highlight energy stocks and strong uptrends. I keep finding them and would not be afraid of those. One of the names struggling a little bit, I'm kind of going all over the place. So I've got a bunch of tickers jotted down that I wanted to share with you guys. But Regeneron, REGN is one of the names that's actually down the most in the S&P today. Regeneron's a tough one. I think Regeneron's an example of where healthcare has been a bit of a challenge. A lot of these names made new highs earlier in the year with Regeneron in April. And I remember looking at this chart here where it had made a resistance level. It had spent about 6-8 months waiting and then finally got above it. It certainly felt like a very constructive chart, but things started to change, right? And all of a sudden it's making new swing lows. It's undercutting the 50-day moving average. Things start to get more and more painful. Why this is an interesting chart now is it has a fairly established level of support right around $600 a share. That was established last December, again in January, February, March, a number of times. Once again in May, we're right back there. So that level of support certainly seems pretty meaningful. Potential that we're able to hold support there. And that's what I would be looking for. If we fail, though, you got to go back to the previous lows around 540, which is another, 60 points, another 10% haircut from where we're at right now. Most recently, that uptrend, by the way, to 700, the RSI didn't even break above 60, which is telling you that overall, this chart is guilty until proven innocent. MAA is another one, Mid-America Apartment Communities. I remember this chart because David Auerbach, one of my guests recently, and I forget when he was on exactly, but I remember looking at this name with him in 2021 when he was on the show for sure. And overall had been just a nice, consistent uptrend. Nice yield on the chart, which is encouraging, but overall the trend is struggling quite a bit. You had this pullback and then sort of this consolidation pattern. And instead of breaking to new highs above 215, it broke to a new swing low. Instead of holding the 200-day, it broke the 200-day. Now I'm afraid we're setting a lower high and now rotating back to the downside. So that's a chart that's more in a distribution phase. Look at how the momentum is more in a bearish phase altogether and certainly underperforming, making a new 6-month relative low, we'll call it today. So a bit of concern on some of these charts that are rolling over a little bit. What else do we want to talk about? Amazon is one. Amazon's sort of a topical name because I had the 10-for-1 split today. What's interesting about this is a long time ago when I was learning technical analysis, which I guess not that long ago, 20 plus years ago or so, but in the early 2000s, I was taught that splits were really important because this would take a stock that was the price was so high that it was inaccessible to a lot of individual investors. By cutting the price down by 2 times or 5 times or 10 times, which is the case for Amazon, all of a sudden it makes it a little more reasonable because you can buy a share for $125 instead of paying $1,200 some dollars to get a share of Amazon. Now we're in the world of fractional shares. So I feel like people that wanted exposure to Amazon with a little money in their account already had the ability to do that. So I'm skeptical that it's more of a news thing. I don't know if it really does a whole lot. in the world of fractional shares. I could be convinced otherwise. And if you think otherwise, let me know in the comments if you're on YouTube, and let me know what you think, or write into the final bar and tell me why I should think otherwise. But what strikes me about this chart, by the way, is if we look at the what I call a candle focus chart, just looking at the candle patterns, do we know what that candle is? It has two names. It depends on whether you call this a doji or not. I would not. I would call this a shooting star candle, which is basically the open and close near the lower end of the range in a big upper shadow. You know, when there's been an uptrend, you open, you trade higher, and then close down toward the lows. That's actually a reversal signal telling you the next couple of days most likely lower. So it seems like that the 10-for-1 split, not necessarily a real bullish follow through on the day. You had that initial rally, but overall finishing more toward the lows. That suggests more of an ominous sign for the next couple bars. Finally, I wanted to highlight a couple names in a pretty good uptrend. We don't need to stick on this chart. This is sort of my standard chart. GNRC, Generac, is in the industrial sector. They make generators, if you're not familiar. What's interesting to me is you had the downtrend late April into early May, a bit of a bullish momentum divergence, now rotating to the upside, regaining the 50-day moving average. Today, really following through Thursday and Friday of last week, which got us above the swing high from last May, remaining above that high, we'll call it 260 or so, remaining above the 50-day moving average around 255. All of a sudden, that's a really nice setup. Now, the first resistance level to watch is 320, which is the resistance from February, March into early April. But overall, a nice setup, and a stock that had been weak, now rotating more to a bit of a positive sentiment. Look at the momentum getting above 60 on the RSI. Another one, compare that chart to the one of ENPH. ENPH concerns me a little bit because instead of it got above its swing high, which is true, around 190. That's a nice break, but further support or further resistance not far above current levels, right around 220. So I think it needs to really regain that to be more of a constructive pattern. So regardless of what the overall market is doing, you're seeing some bounces on some individual names. I'm not struggling to find stocks that are breaking out, and I would be focused on those names with improving relative strength as always. We need to wrap this show, folks, and go to the 3 and 3. Let's hit on 3 charts that tell the story of this market in just under 3 minutes. Here's chart number 1. We're looking at the long bond ETF, the TLT. The concerning part of this chart, as we were talking about in our first segment, our market recap, is the fact that bond prices have certainly been in the downtrend. This is essentially the $ TNX, the 10-year yield plotted upside down, because higher rates mean bond prices are coming down, and you're getting additional yield because the price you're paying less for your Treasury bonds or whatever fixed income instrument you're buying. A bit of a bear flag pattern, which is when you have a big downtrend, then you have a parallel channel of a pullback, higher lows, higher highs. That trend is broken. That trend line is broken, which is what happened last week on the TLT. This is now suggesting further downside for bond prices. This suggests that overall theme for 2022, which we've been talking about, the Fed raising rates and essentially forcing interest rates higher, certainly overall has been the case. Although a bit of a hiccup in the month of May, overall appears to be regaining its some traction, which tells me to be expecting higher rates until the Fed is done with their current trajectory of rising rates. Chart number 2 is the utility sector, the XLU. We talked during our sector setups segment, looking at some charts, and again, the last 6 to 7 months on the utility sector reminds me of energy materials, where you just have this nice consistent uptrend in the relative strength pattern. The price chart is not my favorite, although it's not bad. It's the relative that's most compelling. In a downtrend, in a bear market phase, focus on charts with strong relative strength. Finally, Amazon. If you look at the chart of Amazon, you can see what's called a shooting star candle. That's when you're in an uptrend. You have an open, you trade higher, but by the close, you're back toward the lows of the day. And the open and the close are near each other. Very little lower shadow, a long upper shadow. I would classify today's chart as a shooting star candle, which tells me, despite what you may expect as the outcome of a 10-for-1 split, which means a lot of new investors coming in, not happening today. There's more selling than buying going into the close, and showing some short-term signs of distribution. Folks, that is our show for today. I want to thank you, as always, for joining us on the Final Bar. All of our previous episodes and some fantastic conversations with some really knowledgeable guests are all for free on demand at StockChartsTV.com. You can also see our episodes on our YouTube channel called Stock Charts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.